Welcome to this explainer. Today, we're going to do something a little different. We are looking way past the typical financial lore and those high-level summaries you've probably heard a million times. Instead, we're going to systematically unpack the actual math and the exact mechanics behind literally the most successful hedge fund in history, 𝗬𝗵𝗲 Medallion Fund at Renaissance Technologies. We're going to explore the raw data processing loops and the structural frameworks that allow these guys to, well, seemingly solve the markets.
Okay, let's dive into this. When we think about legendary investors, we usually have a specific benchmark for what success looks like, right? Traditional legends like Warren Buffett, they clock in at an incredibly impressive 20.1% annualized return, and Peter Lynch, up at 29.2%. But just look at the massive disparity when 𝗬𝗵𝗲 enters the picture, 66% gross annualized returns. I mean, that sheer mathematical output completely shatters what analysts thought was even structurally possible.
And this brilliantly illustrates what that gap actually means in reality. $665,810,000. That staggering number is the exact mathematical translation of a mere $100 investment, compounding at that 66% rate over a 31-year period. It's almost hard to wrap your head around, right? But this is the ultimate proof of concept for their engine, and it shows exactly why understanding this machine is so absolutely crucial. So here is our technical blueprint roadmap for today. First, we've got decoding the ultimate return. Second, leverage and signal mechanics. Third, the 7 algorithmic pillars. Fourth, code breaking and machine learning. And finally, retail versus institutional realities. All right, section 1, decoding the ultimate return. Let's go ahead and lift the hood of this market machine to see the core engine block that makes those staggering compounded metrics a reality. Because you see, the secret to that 66% return isn't necessarily about finding one massive, game-changing trade. Actually, it's about this, a 17-to-1 structured ratio matrix. Renaissance Technologies utilizes this precise, highly aggressive leverage matrix. They are literally borrowing $17 for every $1 of their own capital invested. Now, why on earth do they do this? Well, it's because in the raw data, the mathematical edges they find, these unlevered statistical anomalies, are actually quite modest. They're tiny. But by applying this 17-to-1 leverage, they put those tiny unlevered anomalies on absolute steroids, exponentially amplifying them into massive gains. Moving right along to section 2, leverage and signal mechanics. So now that we understand the structural fuel of that leverage, a big question pops up. How do they know exactly where to apply it? Well, they do it through scale. Specifically, a minimum of 8,000 simultaneous short-term signals running constantly across the fund. Just let that number sink in for a second. 8,000. A traditional human analyst, even a truly brilliant one, can perhaps track a few dozen variables deeply, maybe building a complex thesis over a couple of months. But the Medallion Fund? They're generating and executing on 8,000 continuous short-term data points at the exact same time. The sheer, terrifying scale of this operation completely strips away human limitations. Which brings us to section 3, the 7 algorithmic pillars. Now, what's really interesting here is when we shift our focus to the actual software running this engine and dissect the core mathematical models they use to generate those 8,000 signals. Looking at the first strategy, pure quant disassociation, this is all about abandoning gut feeling and fundamental trading entirely, moving instead to a strict casino or house advantage framework. They don't need to win every single time, right? They just need that slight mathematical edge over thousands of bets. Then there's commodity trend following. Here they capture micro-patterns in raw assets, think copper, gold, and crude oil, over very granular timeframes like 20-day horizons. They use moving average crossovers to spot hidden shifts in supply and demand. And finally, mean reversion. This is the mathematical tracking of price deviations away from core structural baselines. They execute short or long positions based on reversion vectors, utilizing some seriously heavy mathematical layers, like the Ornstein-Uhlenbeck process framework, to predict exactly when an asset will snap back to its historical average.
All right, section 4, code breaking and machine learning.
To actually execute those heavy algorithmic pillars we just talked about, Renaissance processes terabytes of multi-frequency data, exploiting alpha signals without ever caring about causality. And this is key. They never ask why something happens. This quote captures their mental model perfectly. They aren't treating the global stock market as a business ledger where you evaluate a company's product or its management team. No. They are applying NSA-style cryptographic code-breaking frameworks to the market. They treat the market strictly as a cipher. It's like a massive puzzle filled with ghost patterns and invisible data correlations scattered across thousands of tickers. They are just looking for the hidden code, completely ignoring fundamental business logic. Let's move to and see how this spills into their actual daily workflow. It basically looks like a massive iterative data processing loop. Step 1 is terabyte data aggregation, pulling in massive amounts of multi-frequency data, which even includes calendar and seasonal abnormalities. Then, step 2 is infinite parallel predictive simulations. And step 3, multivariable hypotheses testing. By relying on iterative machine learning and just absurd amounts of computing power, they are testing thousands of variables exponentially faster than any human ever could. They are literally optimizing their predictive capabilities every single microsecond. But you gotta wonder, who actually builds these loops? Well, this brings us to a brilliant structural decision by Renaissance, their human capital strategy. They actively exploit non-financial intellects. Just look at this list. Physicists, mathematicians, astronomers, statisticians. Literally the top 1% IQ academics in the world. But notice who isn't on this list? Wall Street MBAs. There are none. They deliberately avoid traditional finance mindsets, prioritizing raw, untainted mathematical horsepower over fundamental financial knowledge. And they make sure to lock these absolute geniuses in by pairing them with incredibly powerful equity ownership and partnership incentives.
And that brings us to Section 5, Retail versus Institutional Realities.
So the crucial point is contrasting this elite Renaissance method against the deeply flawed ways everyday traders approach the market. It's the sheer difference in execution. Common retail traders often rely on gut instinct, right? They engage in fundamental trading, getting totally obsessed with seeking the why behind a stock's movement. They always want a narrative. But in total contrast, Renaissance's institutional execution operates on complete cold disassociation. Driven purely by mathematical models, they act strictly as the casino. They have the house advantage. They don't care about the narrative at all. They only care about the statistical certainty of the math.
As we wrap up this explainer, I want to leave you with a provocative, real-world algorithmic scenario to ponder. Think about the intense quantitative rigor required to actually maintain this edge. Ask yourself this deep dive assessment question. If an anomaly, one of those thousands of ghost patterns, suddenly shifts because of a massive structural regime change in a market, how do you mathematically adjust the weights in your algorithm before the leverage wipes you out entirely? That is the true challenge of the Medallion Fund. And understanding that level of continuous dynamic calculation, well, that's the first step to truly grasping the architecture of the greatest market machine ever built.